The Federal Reserve, commonly referred to as the Fed, is the central bank of the United States. One of the most important functions of the Fed is setting the interest rates for the country. Interest rates affect the cost of borrowing money, and therefore have a significant impact on the economy. In this article, we will explore how the Fed decides interest rates and the factors that influence their decision-making process. What are interest rates? Interest rates are the cost of borrowing money. When you borrow money, you are essentially paying to use someone else's money for a period of time. The interest rate is the percentage of the amount borrowed that you pay back in addition to the principal, the amount borrowed. Interest rates can be applied to various types of loans, such as mortgages, car loans, and credit card debt. The role of the Fed in setting interest rates. The Fed has the authority to set interest rates for the entire country. This is done through a process called monetary policy. Monetary policy is the process by which the Fed influences the supply of money and credit in the economy to achieve its goals of maximum employment, stable prices, and moderate long-term interest rates. The Fed has a dual mandate, which means it is responsible for promoting maximum employment and stable prices. The Fed's monetary policy decisions are based on economic data, such as inflation, unemployment rates, and GDP growth, among others. The Fed uses various tools to implement its monetary policy, including open market operations, discount rate changes, and reserve requirement changes. Each of these tools has a different impact on the economy and is used by the Fed in different ways to achieve its goals. Factors that influence Fed interest rate decisions. There are several factors that influence the Fed's interest rate decisions. These include inflation. Inflation is the rate at which the prices of goods and services in the economy are increasing. The Fed's goal is to keep inflation at around 2% per year. If inflation is too high, the Fed may raise interest rates to slow down economic activity and reduce inflation. If inflation is too low, the Fed may lower interest rates to stimulate economic activity and increase inflation. Unemployment. The Fed also considers the unemployment rate when making interest rate decisions. The Fed wants to maintain maximum employment, which means keeping unemployment as low as possible. If unemployment is high, the Fed may lower interest rates to stimulate economic activity and create more jobs. If unemployment is low, the Fed may raise interest rates to slow down economic activity and prevent the economy from overheating. GDP growth. The Fed also looks at the rate of GDP growth when making interest rate decisions. If the economy is growing too quickly, the Fed may raise interest rates to slow down economic activity and prevent inflation. If the economy is growing too slowly, the Fed may lower interest rates to stimulate economic activity and boost GDP growth. International economic conditions. The Fed also considers international economic conditions when making interest rate decisions. Changes in international trade, currency exchange rates, and global economic growth can all impact the U.S. economy. The Fed may adjust interest rates to respond to these changes and ensure stability in the U.S. economy. Conclusion. The Fed's decision to set interest rates is a complex process that involves considering many economic factors. The Fed's goal is to promote maximum employment and stable prices, and it uses various tools to achieve this goal. The Fed's decisions can have a significant impact on the economy and financial markets, and investors often pay close attention to Fed announcements and decisions.